I don't think the swings are going to matter. I mean, I do think silver is going to be over $200 an ounce, if not this year. Within a reasonable number of years, 2 years, 3 years. So your gold got to 5,000. In fact, it actually got to 5,100 briefly before pulling back somewhat. We are headed for a massive economic collapse in the U.S. Now, this whole phony economy, this consumer-based, debt-driven economy that's built on a foundation of the dollar's reserve status is about to come toppling down as that status is lost. 6,000 is easily in the cards for 2026. So that's a 20% move. 5,000 is not the end of this thing. I mean, gold's going a lot higher. This is just one stop along a long journey. Silver, which at one point today was above, I think, $116 an ounce. I was just posting today, because gold got to 5,000. In fact, it actually got to 5,100 briefly before pulling back somewhat. I was posting some old clips of my appearances on CNBC over 10 years ago when I was calling for $5,000 gold. And they were giving me a lot of shit because gold had gone down a bit since I first made that call. So I just put some of those clips out there to kind of rub it in their faces a bit. In particular, because gold has actually outperformed the S&P. So they were accusing me of giving out bad advice and of just shilling my book and preventing people from making money because, I was scaring them out of their stocks and getting them to buy gold. Well, it turns out that if they did sell some stocks and buy gold, they're better off because they did it. Mm-hmm. 5,000 is not the end of this thing. I mean, gold's going a lot higher. This is just, one stop along a long journey. And of course, the bigger action is in silver, which, at one point today was above, I think, $116 an ounce. Mm-hmm. Now it's pulled back. We're now around 110, but it's still up $7 on the day. But I mean, this was the biggest day in the history of silver, and maybe it will be. Who knows? Maybe it'll get back up there. It's been pretty volatile, but gold and silver are going up for a reason, right? There is a very important message, warning, that is being sent by the precious metals market, which is going unheeded, in the financial community and in Washington, D.C. Mm-hmm. But that is the more important. More important than gold and silver going up is why they are going up, what it portends.
This is the geopolitical revenge trade hypothesis. If accurate, it represents financial warfare at the highest level. The setup: European banks Deutsche Bank, HSBC, Scotia, held massive concentrated silver shorts for decades, possibly with U.S. bank cooperation. Tom Luongo's theory suggests Trump believes European elites interfered in U.S. elections and is retaliating economically by encouraging physical delivery and forcing a short squeeze while U.S. banks quietly flip long. European banks face existential catastrophe. A short squeeze to $200 for $100 silver doesn't just bankrupt individual institutions, it triggers systemic contagion across European banking. The U.S. emerges with long positions, profiting from the chaos while geopolitical adversaries face financial ruin. This isn't confirmed, but the timing, policy shifts, and unprecedented delivery volumes fit the thesis uncomfortably well.
I would tilt away from bonds and bonds, and I would be tilting toward gold and have a greater than normal amount of that. I'm also believe that we're in a...
despite the run-up already, meaning you think it's still got...
You always keep, what is my amount that I'm going to keep? Okay? So don't pay so much attention. If I look at the run-up and I take what are the positions held by the entities that should hold what positions, they're still short of gold. Okay? So, but still, I'm not saying that it's what amount should I hold. Okay, don't be overly active, and I don't think most people should be overly active, but do they hold the right amount to diversify? And the other part of the answer to the question is that I believe that we are in a wonderful technological revolution in which there's going to be new tech creating great disruptions, And not so much from, there are the hyperscalers and so on, but there's the impact of those on companies that are going to use that and so on. So I want a part of my portfolio to be in those kinds. So I'm kind of in a mixture of new tech and diversified with an element of gold. That's where my biases are.
So in terms of the biases there, Peter, obviously he went on to talk about 5 to 15% weight in a portfolio, kind of leveraged to gold. And when you get a sense of how much more room there is to run here, what's your take?
Well, I think there's a lot of room to go. The most important thing that Dalio said, and he could have been more precise in the way he said it, but he talked about the fact that there's a change in the monetary order, and that central banks are now no longer considering fiat as a viable asset, reserve asset, and they're moving to gold. What he really means by fiat is the U.S. dollar, because the U.S. dollar is the primary reserve asset, or has been, for central banks, and they're now moving out of dollars into gold. And so foreign banks are going to be backing their currencies with real money and no longer U.S. dollars, and therefore U.S. treasuries. And that is a game changer for the United States. It means a much weaker dollar. It means much higher consumer prices. It means much higher interest rates and a much lower standard of living. And so we are headed for a massive economic collapse in the U.S. Now, this whole phony economy, this consumer-based, debt-driven economy that's built on a foundation of the dollar's reserve status is about to come toppling down as that status is lost. And that is, what gold and silver are telling you.
When the president of the European Commission uses a World Economic Forum keynote to invoke the Nixon shock moment that ended gold-backed money, it's not academic history. It's a declaration of intent. Ursula von der Leyen is telegraphing Europe's plan: reduce dollar dependency, build European monetary independence, and prepare for a post-dollar world order. The fact that this message was delivered at Davos, the annual gathering of global elites, signals coordination. European leadership isn't speculating about whether the dollar-centric system will end, they're preparing for its end. The parallels to 1971 are deliberate. Back then, Nixon unilaterally destroyed the gold standard. Today, structural forces, debt, distrust, alternatives, are destroying dollar hegemony. Europe is positioning to survive the transition.
And we're about to find out that that's not the case.
Well, I want to get into that too, because obviously the thesis, I think, to where we got to kind of top 5,000, going all the way back to when you were talking about it in 2012, like the idea of today's moment versus then, I think it'd be fair to say, back then when you were making the case back in 2012 was much more Fed focused, much more QE focused, much more around some of those economic drivers than it is today around kind of what we're seeing play out in a new world order and what Ray Dalio is now talking about in terms of the risks of civil war and revolution. I want to get to that element of this in a second, but first, just to double down on the question in terms of how much more room to run. It's interesting to kind of see what's playing out, but then also you have analysts like Goldman and a few others basically saying that there's only a 6% move to year end in the price of gold. UBP saying 52 per ounce at the end of the year, Goldman saying 54. What does Peter Schiff say around 2026?
Well, first of all, Wall Street has been underestimating the strength of this precious metals move, since the inception. In fact, many firms just even denied that there was going to be a move. So I think they're wrong in that. I think the bull market will be much bigger, and so prices will probably go a lot higher. But I couldn't say exactly how much higher they're going to go. I just think that they're going to go quite a bit higher than what Wall Street believes, and who knows what they actually believe. What they tell the public and what they believe, in many cases, may be very different.
This segment brilliantly articulates why tokenized gold represents blockchain's actual value proposition, while Bitcoin is a speculative Ponzi scheme. The core distinction: tokenized gold digitizes ownership of a real asset with intrinsic value. Bitcoin digitizes nothing and requires perpetual faith that the next buyer will pay more. Schiff's custodian trust versus pyramid scheme trust comparison cuts deep. In a free market, custodians compete for reputation and can be held accountable. Bitcoin's value relies on the pyramid continuing indefinitely, which history proves impossible. The kicker: Every purported Bitcoin advantage, borderless transfers, digital ownership, disintermediation, can be achieved with tokenized gold or stablecoins. Bitcoin's unique feature is only that it's backed by nothing. That's not an advantage, it's a fatal flaw.
It's not so much spillover. It's just the factors that are driving gold higher and silver higher are also going to drive copper higher. Not necessarily that central banks are going to be buying copper as a reserve asset, but the primary motivator for the desire to own gold and silver is inflation. Inflation is driving central banks out of fiat currency, out of dollars into gold, and it's in driving investors, into silver. But it's also pushing up prices, and the prices that are the most sensitive to inflation are commodity prices, and so you're seeing the next wave of inflation in commodity prices. That's before you're going to see the prices reflected, in the CPI. You're going to see them in commodities, and that's what's happening. And so copper is being pushed up by inflation, and so are all the prices. Ultimately, that's why prices go up. It's because governments create inflation.
Schiff's price targets are conservative estimates based on dollar debasement, not gold mania. The $6,000 to $7,000 gold range by 2026 represents only 20 to 40% gains from current levels, modest compared to silver's potential 100% move to 200 plus. But the critical reframing Schiff offers is that gold isn't going up. It's maintaining purchasing power while the dollar collapses. Each new high in gold represents another step down for dollar viability. If the dollar loses significant value in 2025-2026 due to foreign central banks selling, treasury market collapse, or renewed money printing to fund deficits, then $7,000 gold isn't optimistic. It's mathematical. The question isn't how high can gold go, but how low can the dollar fall? There may be no ceiling.
I think the idea that gold moves first and then Bitcoin moves second is just made up. There is no proof whatsoever that there's any correlation at all between gold and Bitcoin. I mean, Bitcoin's only been around for 16 years or so. And during that time, gold went sideways, really, from 2011 to 2024. So gold didn't really make any progress. So whatever happened to Bitcoin during that time period had nothing to do with gold because gold didn't go anywhere. And in fact, I think it's because gold didn't go anywhere. That's one of the reasons that the Bitcoin promoters were able to get a lot of people to buy Bitcoin because they said, look, gold's dead. Gold is the past. It's no longer the store of value it used to be because Bitcoin is now here and Bitcoin is better. It's gold 2.0. Old gold is analog. It's like a horse and buggy. And here's this shiny new sports car that's zooming around the track. But, ever since gold broke out really in early 2024, Bitcoin hasn't gone anywhere. In fact, Bitcoin has gone down in terms of gold. In fact, it's way down priced in gold by about 50%, actually a little bit more than 50%. If you go back to its peak from the November 2021 high. And that really was the top of the Bitcoin market. It kind of retested that level later last year and then failed miserably and collapsed. But I think you got a big double top in Bitcoin priced in gold. We're already down by 50% from that top. But I think we're still early in this bear market for Bitcoin. And I don't think it's just a bear market. I think it's air coming out of a bubble. And so it's got a long way to go down. I think last year, the entire false narrative that Bitcoin is some digital version of gold was eviscerated. It's clear, or it should be to everybody, that Bitcoin ain't gold. It's something completely different. And so if you want to buy gold because you're worried about inflation, you're looking for a store of value, you're looking for an alternative to the dollar, Bitcoin is not your answer, right? You still go to gold. If you want to collect Bitcoin because you think people are going to buy Bitcoin, that's a different trade.
This is one of the most important segments because it preempts the inevitable scapegoating when the crisis finally hits. When the economy collapses, Politicians and media will blame unfettered capitalism and greedy corporations while demanding more government intervention. Schiff exposes this cycle. Government creates inflation through money printing, which disproportionately benefits asset holders, the rich, while destroying purchasing power for wage earners, the poor. The resulting inequality gets blamed on capitalism despite being caused by intervention. The solution, more regulation, more spending, more control, guarantees the next crisis will be even more severe. This doom loop has been running since the New Deal, accelerating through each successive crisis as government grows and freedom shrinks.
The thing is, Bitcoin is not digital gold. What would be digital gold is a tokenized gold, because tokenized gold represents ownership of gold in a digital form, but it's backed up by the real thing. So like T-Gold, for example, when we start issuing our tokens, like right now, if you go to tgold.com, you can buy gold and silver and we will store it for you.
Mm-hmm.
It's that stored gold that's ultimately going to be tokenized if you want it tokenized. So basically, if you have an account at tgold.com and you want to withdraw your gold, we can either send you the physical metal or we can send you a token that represents ownership of that metal that you can then transfer to third parties who would have the same choice. They could either take the token back to T-Gold and redeem their physical, or they can hold it and they can, transact with it and use it as a medium of exchange. That's actually digital gold, because it's gold where the ownership is represented digitally and it moves by blockchain. I mean, that's why, when I did the thing with CZ and he sticks this, kilo bar in my hand and says, is this real gold?
Yeah.
And he thinks that somehow Bitcoin is superior because it's instantly verifiable. Well, tokenized gold is also instantly verifiable because it works on the same principle. It's on the same, blockchain technology. The big difference is, yes, you do have a custodian that holds the actual gold. That is the basis of the value of the token.
Mm-hmm.
Whereas with Bitcoin, there is no custodian because there's nothing behind Bitcoin. So if you don't have any real asset backing up your digital currency, then you don't need a custodian. But what you do need is something that's, I think, even riskier. You need trust. You need confidence and faith that something is nothing, that the people who want Bitcoin today will still want Bitcoin tomorrow, that the people who believe it has value will continue to believe that way. See, with gold, you don't have to take a leap of faith at all. Gold is gold. It always has value. It doesn't matter what I think or what I believe. It's gold. The value comes from the physical properties of the metal and all the things that you could do with that metal. So I would rather trust a custodian in a free market who is competing for reputation to hold my gold than to trust that a pyramid scheme keeps on building. When I know from firsthand experience or from knowledge that no pyramid, no Ponzi, no chain letter can ever go on indefinitely. They all collapse. That's why they're illegal by and large, because they don't work. And Bitcoin is no different.
Well, I think the idea of what you're describing around tokenized gold does seem kind of similar to the way that the Bitcoin community reacted to the idea of Bitcoin ETFs versus self-custodying your Bitcoin, which is kind of interesting to think about in stressing some of those things.
I always believed that, a Bitcoin ETF defeated the entire purpose of Bitcoin. If you're going to have an ETF, you might as well have a gold ETF, right? If you're going to have a third party storing it, you might as well go with gold. The idea behind Bitcoin is there is no third party. You're your own custodian. There's no bank. And so I get that. I get the appeal of that. All of that was lost on the ETFs, which really is a vehicle.
But if you understand that, would you agree that the idea of transferring wealth or money across borders, if it comes to that, would be actually somewhat a significant appeal to digital gold or Bitcoin? I know you don't want to call it digital gold, but to Bitcoin over an asset.
No, because I can transfer tokenized gold just easier than I can transfer Bitcoin, and that's real wealth.
This segment brilliantly articulates why tokenized gold represents blockchain's actual value proposition, while Bitcoin is a speculative Ponzi scheme. The core distinction: Tokenized gold digitizes ownership of a real asset with intrinsic value. Bitcoin digitizes nothing and requires perpetual faith that the next buyer will pay more. Schiff's custodian trust versus pyramid scheme trust comparison cuts deep. In a free market, custodians compete for reputation and can be held accountable. Bitcoin's value relies on the pyramid continuing indefinitely, which history proves impossible. The kicker: every purported Bitcoin advantage, borderless transfers, digital ownership, disintermediation, can be achieved with tokenized gold or stablecoins. Bitcoin's unique feature is only that it's backed by nothing. That's not an advantage, it's a fatal flaw.
The big wealth gap is not an accident. It is a byproduct of the exact same monetary and fiscal policy that's destroying the economy. That's created all the inflation. Government has done that. Capitalism would not produce that kind of dichotomy between the rich and the poor. Yes, there's always going to be a difference because in capitalism, the people who contribute the most make the most, and the average person doesn't contribute very much at all compared to what a business owner would contribute. But they still benefit from capitalism. They see the value of their labor improved based on the productivity that is introduced by their employers, by inventors and other creators who have found ways to enhance the productivity of their labor, and they benefit from that.
Mm-hmm.
But the policies that we've pursued have really robbed the common man of the benefits that ordinarily would have been bestowed upon him by capitalism. And so the government actually sowed the seeds of the crisis and then, tries to somehow hold itself out as the savior by claiming that it's capitalism that is the problem and that more government is the solution, when it's government that is the problem. And the only solution is to eliminate a large portion of the government. But that's never what happens. We get a government-created crisis, and then the solution is to make government even bigger to ensure that the next crisis is even worse, which means we get even more government. So
this is one of the most important segments because it preempts the inevitable scapegoating when the crisis finally hits. When the economy collapses, politicians and media will blame unfettered capitalism and greedy corporations while demanding more government intervention. Schiff exposes this cycle. Government creates inflation through money printing, which disproportionately benefits asset holders, the rich, while destroying purchasing power for wage earners, the poor. The resulting inequality gets blamed on capitalism despite being caused by intervention. The solution, more regulation, more spending, more control, guarantees the next crisis will be even more severe. This doom loop has been running since the New Deal, accelerating through each successive crisis as government grows and freedom shrinks.
the swings are going to matter. I mean, I do think silver is going to be over $200 an ounce, if not this year, within a reasonable number of years, 2 years, 3 years. So you're still going to have a decent return in silver, even if it goes down first. But who knows? I mean, maybe it just keeps going up. But I think gold, now that it's surpassed 5,000 again, I think 6,000 is easily in the cards for 2026. So that's a 20% move. I think that's more than you're going to get from the stock market.
Yeah.
But gold could go up a lot more than 20%. It can go to 7,000 this year. It can go higher. I don't know. But because a lot of it isn't about what gold is doing. Gold's really not doing anything. It's what the dollar is doing. It's how much value the dollar is losing.
Schiff's price targets are conservative estimates based on dollar debasement, not gold mania. The $6,000 to $7,000 gold range by 2026 represents only 20 to 40% gains from current levels, modest compared to silver's potential 100% move to 200 plus. But the critical reframing Schiff offers is that gold isn't going up. It's maintaining purchasing power while the dollar collapses. Each new high in gold represents another step down for dollar viability. If the dollar loses significant value in 2025-2026 due to foreign central banks selling, treasury market collapse, or renewed money printing to fund deficits, then $7,000 gold isn't optimistic. It's mathematical. The question isn't how high can gold go, but how low can the dollar fall? There may be no ceiling.
Well, again, I've been right about gold a lot longer than that. I mean, I pointed out on one of the clips I put on my X feed earlier today when Scott Nations was making fun of me at the time for recommending gold, and because gold was like 1,200 or something, and he said, "Well, I've been recommending it for 10 years," and he said, "Well, and you've been wrong for 10 years." Like, how am I wrong? Gold rose from under 300. Gold has gone up more than the stock market. So how am I been wrong telling people to buy it? I haven't been wrong. I've been right for 25 years telling people to buy gold. And I haven't just told them to buy, I bought it myself. It's not like I'm, just telling other people to do it. I'm doing it, and I'm recommending that other people do the same thing. So yeah, I mean, it's nice to make money. I made a tremendous amount of money on my positions last year on paper. I haven't really sold anything. So I haven't, I still got my chips on the table, so to speak. But on paper anyway, I made more money last year than I've ever made on paper in my life. And this year is starting out even better than last year. So yeah, it's better to make money than lose money. And yes, there is a satisfaction in being right and being proven right. And I think a lot more is going to happen in the next several years that's going to prove me more right. And in fact, the lion's share of the vindication is still coming.
The personal element here is important because it demonstrates conviction versus salesmanship. Schiff didn't tell others to buy gold while personally avoiding it. He put his own wealth on the line based on his analysis. This distinguishes him from talking heads who promote positions they don't hold. The timeline is also crucial. A 25-year bull market from under $300 to over $5,000 represents a 16x return, handily beating the S&P 500 over that period. When critics claimed he was wrong because gold had pulled back from $1,900 to $1,200, they were cherry-picking timeframes. Over any meaningful long-term period, Schiff's gold thesis has been validated. His comment about the lion's share of vindication still coming is chilling. He's saying the really severe consequences haven't hit yet.